All right, welcome back, everybody. Alphabet was the final FANG name to report fourth quarter results, and it was the only one to disappoint when it came to revenue. That is pressuring shares ahead of the opening this morning. If you take a look at Google shares, you'll see they're down by about 3%. Joining us right now to react to the results is Kevin Rippey. He's an analyst at Evercore ISI. Also, Tim Lesko, who's a partner at Granite Investment Advisors. Gentlemen, welcome to both of you. And Kevin, let's start with you. People are pointing to a lot of different reasons as to why there's the stock's down by 3%. What is the metric that's most important to you? Is it missing on revenue? Is it the operating earnings, or operating income, or is it just kind of seeing some of the details for the first time?
Well, I'd say, also similar to Facebook, you had what would you characterize as a solid but not stellar revenue quarter, right? So we had numbers that came in line with sell-side consensus, with probably a few $100 million shy of what the buy side would like to see. And we saw a big deceleration in U.S. revenue growth. So I think that's going to be areas for concern. People think about the broader digital ad market and a potential sort of big picture slowdown, and probably focus on that for the near term.
I was looking through, and some people were complaining about the idea that, look, they are having to rely on YouTube and other areas for more and more of their growth instead of just having it come through Google. It was the opposite complaint when Facebook reported. Everybody said, oh, no, they're getting all their growth from Facebook and not from these other areas like Instagram. Does any of that matter?
I would say in the case of Google, it matters a little bit more because the margin profile of those businesses is quite a bit different. When you think about Facebook and Instagram, fairly similar. So the sort of revenue mix there has a big determination of what your profitability growth is going to be going forward.
Tim, you're a shareholder. What do you think about the earnings?
Well, I thought the earnings were great. Revenue certainly missed people's expectations, but it's still significant growth. And in a growth portfolio, it's very hard to find this kind of growth at this reasonable a multiple. So we're a little shocked by the street's reaction, but in the short run, that's kind of always what happens.
If you're shocked by the street's reaction, does that mean you see this as a buying opportunity?
Certainly a buying opportunity for those people looking for that kind of growth. I think maybe the fear is a little bit overdone.
Is that you, though? Would you be buying today?
Well, we own a full position in it, so we will take a look at it as we do every time somebody reports earnings. We're long-term investors, so we're typically not trading it off of earnings, but certainly 3 or 4% down would create an opportunity for us to add to positions.
Tim referenced the multiple. How much is it constrained because of the regulatory overhang, the antitrust proceedings here in the United States and everything else that's going on in Europe? If not for that, what would Google's multiple be? Where would it be?
Yeah, I think that probably is the number one question we continue to field from investors. And at this point, I would say it's almost an impossible question to answer because there's so many factors to consider. And having one, if someone's going to suggest one number, they probably haven't thought about it hard enough.
Let me ask you a cloud question.
Sure.
You look at the cloud business, you see how successful Azure was at Microsoft. You see what's going on the AWS side. How excited or not are you about Google?
I would say, personally, it's 6 out of 10, something like that, where there is enormous strategic value in what they can pursue. It helps the narrative. But in terms of playing from behind,
right,
they certainly are in a distant third.
Distant?
Yeah.
And is it more distant than you thought?
I think actually, and this speaks to the improved disclosure, which we were a huge fan of. If I look at where YouTube is, I look at where cloud is relative to probably where our estimates were and where consensus was, it was actually very close. So not a necessarily ton of surprise there, but the fact, particularly Azure, those growth rates are quite striking at a scale that's quite a bit bigger than Google's cloud business. So you do start to think, how much momentum do they need to build in order to play catch up?
Tim, as a shareholder, how do you feel about other businesses, all the stuff that they're throwing money at that, on the one hand, people will argue, oh, you need to go out and find other avenues of growth and you have to take risks with R&D and self-cannibalize, et cetera. At the same time, a lot of people look at that money and think, wow, it's a waste and it's hurting the final financial results of the company. Are you a fan of them spending that on other businesses, or would you rather they didn't?
Well, I think that gets back to something that happened a few years ago when they brought in Ruth Porat and they decided to begin to tell us about those other bets and really let us drill down into numbers. Yesterday, we began to see more numbers from Google, which I think is a really big step forward for shareholders. We really want to know what the margins are at each of these businesses and how each of these businesses is growing. And we don't love the other bets. We don't like space shots, but we do like driverless cars. We do like other areas of healthcare that they're getting into. So there's a lot to like about the other bets, and I think that they've done a much better job of disclosing what they are.